We were in black and white because the numbers are not looking very good. The screen is giving us extremely negative cues from the United States. 2% down today, 10% down for the month, and it's being the slowdown cues are all over the place. Good morning again.
Hi Lata, good morning. Yes, second day running, right? The Dow has seen this big fall overnight. I mean, almost 500 points, sitting at a 17-month low. But then our own markets have seen so much resilience. I mean, I was just looking at the month of December itself. The MSCI India index is up almost 1% at a time when S&P 500 is down 9%. Even MSCI emerging market itself is down about 4.7%. So the big question is, this outperformance that India has seen so far, is it something that you expect could continue?
Well, I can explain the outperformance, but I can't predict the outperformance. The explanation really is, why is the Dow in such a skittish terrain? It's not just that Jerome Powell was not dovish enough. It is because he said that the Fed's balance sheet reduction program will go unhindered. That is, they're going to cut their balance sheet by $50 billion every month. That much of treasuries they will not buy. They will allow it to mature. What is India saying? Exactly the opposite. That every month we are actually going to buy, we're going to expand our balance sheet by 50,000 crores. So it's exactly, the opposite that's happening in India. And that's why India is not responding to what's happening in Wall Street indices and elsewhere in the world. There is a crunching of liquidity. Here there is an expansion of liquidity. And of course, we've had some other positives coming our way as well, with the banks getting recapitalized, even as they have gotten cleaned up. They should be raring to lend. And finally, there was another something which measure which we couldn't discuss because it came very late yesterday. The Reserve Bank has increased the limit of external commercial borrowings that can come into the country. Basically, foreign loans. We call them ECBs. Now, actually, every year they allow about $30 billion or $35 billion to be raised. Now they've put in a formula. It shall be 6.5% of the GDP, and that works out to 160 billion. 127 billion has already been raised, so 126.2 has already been raised. So another 34 billion can be raised in this fisc. Now, it's not necessary that the limit will be exhausted. And I would also worry if money came in too much too soon, because that would be the Dutch disease. That would mean the rupee would become strong, and that's not good for any economy. A strong currency is not good for any economy. And therefore, I hope people don't go hand over fist and running to get that money. As well, I hope the limit has been raised, but the rules to raise abroad are not weakened. At the moment, there is a restriction on the tenor. You can't borrow short-term money from foreign countries. You can only borrow 2 to 5 year loans from dollar loans. I hope those rules are not diluted. So long as it is only a quantum increase, but the rules remain the same, I think we can live with it, but let's hope that we don't get a flood of dollars.
Okay, well, let's hope the outperformance that our market's seeing could continue today. I mean, as we speak, the Japanese index is down about 350 points. Hong Kong is having a very rough run as well. So let's see which way things go. Yesterday, we saw a recovery in late trade and we managed to close on flat terrain. But let's see what our wise experts have to say. We hardly have 10 days to go before the year comes to an end. Mark Schofield of Citi thinks weaker asset returns are consistent with lower growth forecasts and reduced earnings expectations. He says this environment is likely to persist. However, he does not think that we are in a bear market for equities just yet, and this feels more like a mid-late cycle correction. Citi is overweight equities and underweight credit. He says they are overweight US treasuries. They remain bearish on the US dollar, and in commodities they are slightly long.
Okay, and with that, let's get to money market cues as well. Bhaskar Panda of HDFC Bank says, as expected, the US Fed hiked 25 basis with a dovish outlook for future rate hikes in 2019. He says US yields fell and global crude prices bounced back a little after falling almost 5% in one session. As far as Indian markets are concerned, Bhaskar Panda says the rupee gained against the US dollar yesterday on the back of lower oil prices and higher one-time flows. Today, he adds, the same trend may continue. He expects the USD INR pair to trade in a range of 69.80 to 70.
And on the bond market, he says the benchmark yields in India have been adjusting downwards on global and local positive cues. He says the 10-year benchmark bond yield bounced back yesterday on profit-taking, and today he expects a range trade between 7.25 to 7.30%. Okay, as you heard earlier, the Dow has seen its worst December since the Great Depression. 2 straight days of huge losses. Nigel is here to give us the world view. Hi, Nigel. Morning.
Well, good morning. Not great cues really coming in overnight. All those 3 frontline indices, they ended in the red, and all the 3 indices, they closed at its lowest levels that we've seen in the last 14 to around 15 months. So things didn't look very, very good. Couple of fears that were playing out yesterday. One was that, in fact, the Fed indicated they're going to go ahead and they're going to hike, continue hiking interest rates at the pace that they've done. So that was point number 1. Point number 2 was there are fears that the government shutdown could, in fact, happen because President Trump, in fact, said overnight through the House of Representatives Speaker, that's Paul Ryan, he said that President Trump will not be signing any kind of deficit number, any temporary funding till the wall funding was done. So that was another fear that lingered on. And yesterday, you did have a lot of stocks that were selling off. In the month of December, as Sonia said, we're having the worst December all the way since 1931. That's the Great Depression. And all those frontline indices were down close to around 9 to around 10% in this month so far. Plenty of losers, though, as I said. You had the likes of McDonald's that was under pressure, Walgreens as well was under pressure, and United Tech as well did see selling. But shifting focus to the European markets, out there as well in yesterday's trading session, there was selling across the board. Autos, basic resources, all of them were selling off. In terms of central bank action, Bank of England, they kept rates more or less unchanged, and that was on expected lines. But the pain was seen in the broader markets as well, because peripheral Europe did sell off, and in fact the emerging markets as well ended with cuts of around 0.5% to around 1%. This morning, the Asian markets, they're trading with quite sharp cuts. The SGX Nifty, though, is indicating a 20-point downtick. Crude oil prices, remember, still hovering around $55 per barrel, which will be good for our markets. Back to you.
Thank you very much, Nigel, for that. Already in somewhat Christmas attire, Nigel D'Souza, he gave us lovely marzipans for Christmas. That's the pleasant part, and we will start enjoying perhaps by end of day today, Friday evening. But it's not looking like a good Friday morning, especially if you had made the mistake of being a crude bull. David Lennox, the analyst from Fat Profits, has joined us now. Good morning, David. Greetings of the season to you as well. You're entering a festive weekend. But before that, some probably unhappy talk if you're a crude bull. This fall is relentless. Yesterday, 54.25 on the Brent at one point in time. Where does this stop?
And season's greetings to you as well, Arthur. Look, we've certainly been an oil bull for some time, and we've stuck stubbornly to our 74 to 84 Brent price end of year. That's obviously not going to come about. But if you have a look at what we're seeing happening at the moment, we've got a number of factors that have definitely played into the bear's hands. And the first is that we've seen both Russia and the Saudis increase production given their November reads. We saw the Russians adding about 200,000 barrels and the Saudis about 400,000 barrels for their November end of month production rates. So given that we're now rushing towards the end of December and we're expecting in January to see that 1.2 million rate cut in production coming in, if we see both the Saudis and the Russians increasing their December production, then the rate cuts are pretty much negated. And that's what's really concerning the market at the moment. And that's why we've seen the oil prices primarily fall away. What they've been promising to come, they've already perhaps made up in increasing production up until this point. So that's really the key. And of course, we've seen that the US production rates are now around 11.6 to 11.7 million barrels. That's been rising consistently over the course of 2018. There are forecasts that in 2019 that could hit about 12 million barrels. So if that's the case, then supply is going to be more than adequate. And again, playing right into the bear's hands. Where does it go? Arthur, we've always suggested that OPEC will keep the Brent price away from $50. We think that that's going to cause disruptions to their countries. And at the moment, it's sitting at about 55. We can't see it going much lower from here.
David, hi, good morning. Yes, in fact, OPEC and its allies have been scrambling to boost confidence and, talking about slashing production, etc. If they manage to do that, would you change your view on Brent for the next, say, 3 to 6 months?
Oh, look, there's no doubt about it. If OPEC come in and do actually implement the 1.2 million cut that they're suggesting will happen in January, and we do see the December numbers come in when we see them and they haven't increased their production from November levels, then yes, that will give the market some confidence again in the supply side for oil, and we will see that adjustment. You've got to remember the last time we saw oil in this sort of territory, the recovery was what we call a V-shaped and very quick. And that was primarily on the fact that OPEC has the ability to cut production, and that does impact on supply and very quickly the oil price. So we will be calling for the OPEC members to actually make sure they stick to and implement that cut, and that we believe will bring the oil prices back up, probably closer to the $65 level than where they're trading at the moment.
Yeah. I take all your points that you have detailed about supply increases, but lately we are also hearing about a demand issue. As it is, the Wall Street indices are falling, fearing lower growth. Jerome Powell admitted it by cutting down the US GDP forecast. And now, today, we are also getting some bit of negative growth cues or worries from Asia as well. How would you assess that as impacting crude prices?
Oh, there's no doubt about it that we've seen over the course of the last probably 2 or 3 months, OPEC themselves have been pulling back demand. They're now sitting at just over 100 million barrels for next year. We've actually suggested that in 2019, we'll see about 99 million barrels of demand. And that's going to be flat on, we think, a 98 to 99 million barrel demand for 2018. So from that perspective, we're not looking for any increase in demand. We're not also expecting to see any significant fall either, because two major consumers in China and in your own country, India, still continue to grow at quite a decent pace. So if that's the case, then demand for oil coming out of both those countries, we believe, will keep demand overall in 2019 very flat, as I said, at about 99 million barrels of oil per day.
Fair question. When is this V-shaped recovery expected?
Latha, if I knew that question, I'd be jumping in really quickly.
Yes.
Look, it's difficult to say because we're a couple of weeks now from the end of 2018. We will be looking for OPEC to instigate and implement the production cuts of 1.2 million barrels. And then, of course, a couple of weeks after that, we'll be looking to see what the December numbers look like. So one would expect that during this period of waiting, that we're not going to see any significant recovery in the oil price until firstly we know that those cuts have come into being, and then we know what the December oil numbers look like, and that they haven't, let's say, smudged or made up the figures early. And if that's the case, then we'd expect to see perhaps sometime towards the middle of January a recovery in the oil price.
Okay, all right. We will let you go on that note. Merry Christmas in advance, and hope you have a great weekend with your team, with your family and everyone back home. That's the word coming in from David Lennox. There are two issues because of which crude prices are falling. Demand is under pressure and the OPEC is unable to slash production, at least at the moment.